Good morning, guys. Today we're going to look at a few influences on finance. Firstly, looking at the government. Basically, ASIC stands for the Australian Securities and Investment Commission. Their role is to ensure that all corporates or companies, so people that are publicly listed or privately owned companies, follow the law. They collect information about companies and make it available to public. So you actually search their website to find information about any company. All companies have to lodge their tax returns and their financial dealings with ASIC, and they're all publicly available. It's kind of one of the disadvantages of particularly a public company, is that you have to actually publish your results every year. And the Taxation Office basically is responsible for connecting taxation revenue from companies as well as individuals. Company tax rate, remember, is 30% of profits only. So a lot of businesses actually spend a bit of effort trying to make sure that their profits aren't too large. Do things like carry forward expenses from the year so they can tax deduction on that. Use a lot of leasing, so they're all tax deductible, so they reduce their overall profits, so they pay less tax on it. Global markets basically have a huge impact on Australian businesses. I don't know if you watch the news every night, but the financial news talks about the relationship of our dollar compared to other dollars and what's happening in other markets. If things go bad in the New York Stock Exchange, Australia generally follows the next day. If things go well, again, Australia follows the next day. We're very much in lockstep with the New York Stock Exchange. Global market influences basically have a huge impact on the economic outlook in Australia, the availability of money for lending in Australia, although that's less so now because of the superannuation we discussed yesterday, and also setting of interest rates. Money goes where the interest rates are higher, so if one country has much lower interest rates than others, a lot of the capital will flow out of that to where they can get higher returns. So Australia lives in a global economy, and what happens overseas affects us dramatically. Now, looking at the global economic outlook, if things are positive, if people businesses are investing, then there's generally an increased demand for goods and service, and interest rates actually decreases. There's a lot more money, people are willing to invest it, so the supply of money is greater, so the interest rates are lower. Good times for business. However, if it's negative, there's reduced demand for the goods and services, and lenders tend to get a bit tighter and more risk averse, so therefore they either stop lending, which dries up the supply of capital, or when they do lend, they demand higher interest rates to cover for their risk that they're now taking. So when the availability of funds starts to decline and negative outlook, there's increased risk. There will also be increasing demand, decreasing supply. It means the domestic supply will actually decrease as well, so it makes it much harder to get a home loan. At the moment in Australia, for example, we're awash with capital, and it's actually fairly easy to get a home loan, which is driving the house price increases around, particularly New South Wales and around Sydney. When interest rates start increasing, it's generally because of risk, and this drives up. We saw this in 2009 with the American housing crisis. A lot of lenders have been lending money to anybody who wanted it. A lot of them went bankrupt, which drove the risk up, which forced a lot of foreclosures, basically precipitated a global financial crisis. Lenders just stopped lending money. They became very risk averse overnight, and you couldn't get a loan for love or money. And if the exchange rate fluctuates wildly, it increases the risk, and so they'll be factored into interest rates as well. Our exchange rate is remarkably stable. We normally hover between 70 and 75 US cents per Australian dollar. We're right in the middle of that at the moment. That stable exchange rate lowers the risk and basically allows the money supply to increase. All right, we'll leave it there for today.